I have to digress off the usual Fed discussion here and talk to you about a magazine cover of February 15th, 1999. Greenspan Rubin and a younger Lawrence Summers in a time of Asian crisis. With dollar strength and with anticipated Fed rate increases, do we see an emerging market fragility which could lead to something related to the August of 1998 that you lived?
I doubt it in the same way. Central to that crisis was fixed exchange rates, were very low levels of reserves in many emerging market countries, and were debt that was predominantly or heavily dollar denominated. I do think that the combination of high energy and food prices, a rising dollar, and increasing interest rates does pose risks to emerging markets, but I think they're not likely to be systemic and across the board in middle-income countries. I'm more concerned about countries with particularly unsound policies. Turkey would be an example, or Argentina would be an example. Countries with particularly problematic food situations. Egypt would be an example, but I don't think there's going to be the kind of massive across-the-board financial distress that we saw earlier.
Professor Summers, I saw a chart this week on the Bloomberg I have never, ever seen in my life, which is the zombie nature of Japanese yen weakening. Again, this is away from the United States, but when you see the lethargy of yen weakening, given the experiment of yield curve control, how would you suggest that will end for Japan? How would you suggest that will end for the markets?
You know, Tom, the problem with pegging financial variables, whether it's an exchange rate or a long-term interest rate or a stock price, is that it tends to be a much easier strategy to enter than it does to exit. And I think that's got to be an issue for Japan. Sooner or later, they're going to have to leave the yield curve control strategy, and I'm not entirely sure what's going to happen when they do. I think in the meantime, the pressures are likely to build, and as they provide more and more liquidity, it could easily lead to an even weaker yen, especially given that as inflation surprised on the high side here, market participants revised upwards their expectations of how high interest rates are going to have to go in the United States.
Larry, let's get back to the United States here. And just as a general statement before we look at 9.1% inflation, are we asking too much of our central bank? We had a massive fiscal expansion. I guess we're trying to do a fiscal unwind off this pandemic. Are we just asking too much of our central banks today as an institution?
I don't think so. I think we are asking for our central banks to analyze the economy accurately. We are asking our central banks to keep in mind their primary mandate of price stability. And frankly, I think in 2021, our central bank lost its way. It was talking about the environment. It was talking about social justice in a range of things. It was confidently dismissing concerns about inflation as transitory, and it made mistakes in the core functioning of a central bank, including leaning into highly expansive fiscal policies rather than accommodating them as our central bank did. So I don't think we were asking too much of our central bank, but I think in 2021 our central bank let us down quite badly, and as a consequence they find themselves in a very, very difficult position, not least because they don't have the credibility that they once enjoyed, given their repeated poor forecasting record. And I have to say that it's not something that's been fully fixed. Their most recent dot plot suggesting that unemployment would get to 4%, get only to 4.1%, even as inflation came completely down, seemed to me to be highly implausible. And the fact that the most pessimistic person of the 19-member open market committee was saying 4.5% seemed to me to suggest a degree of highly problematic groupthink.
Larry, you've taken a victory lap among all in economics here with how far out front you were on inflation. I want to go back to a modest textbook of 1948 by a guy named Samuelson. And like 2 years later, 1 year later after the 1948 miracle of his textbook, there was sky-high inflation like the 9.1% inflation we have now. Not once, but twice we came down into the Korean War, into an Eisenhower disinflation and outright deflation. Do you have an optimism we can move from 9.1% inflation down relatively rapidly?
I think it's pretty clear that there are some factors, like what's just happened with gasoline prices, that are going to point towards disinflation. But I think that if you look at core measures of inflation, if you look at so-called trimmed mean, a range of different indicators, what they tell you is that this is a pretty pervasive expansion in inflation. And my reading of the experience of the last 60 years is that those don't tend to be reduced completely without significant economic slack. And I think if you look at the level of vacancies in the economy, the ratio of vacancies to unemployment, or the level of quits, you see that we have a currently overheated economy. So we have some distance to go just to get back to neutral.
You wrote an initial paper with a guy named Martin Feldstein. This is a few decades ago, to say the least, Larry. He codified NBER as our measure of recession. And your colleague, Jeffrey Frankel's done great work on this. Like, actually, how do we choose to define a recession and the magnitude of recession? The parlor game right now of recession, I've never seen. The guessing of it, the gaming of it. Give us some clarity on how you define recession and the magnitude that we could see.
You know, I think the classic definition of a recession is a broad-gauged, multi-month decline in a range of economic indicators of activity. And that's something that the NBER makes a judgment about. There's a kind of crude approximation that many economists use, which is 2 negative quarters in a row. I think there's a quite reasonable chance, probably 50% or a bit above, that we will in the first and second quarters have negative growth in both quarters. I don't think that is itself sufficient to establish a recession, because it's heavily being driven by demand that draws down inventories and demand that draws in imports. But I think there's a real risk that we'll see it through this year, and an even greater risk that we'll see it next year. I would say the odds are certainly in the far above half, probably above 3/4 of seeing a recession within the next 2 years. And I don't think there's any reason why it needs to be a recession like we saw in 1982 or like we saw during the great financial crisis.
Right.
But I think it's not going to be a walk in the park either. And I would suggest as a kind of rough model what we saw after the bubble burst in 2000.